So we are going to talk about what to do after you've maxed out your TFSA. So this has caused all sorts of problems with our wealth managers, which is interesting, because I kind of told them the topic and I bounced it off our kind of wealth brains last night, and there was a huge debate about whether you should start with a TFSA or you should start with an RA. Or at what point, what is your first savings vehicle? Now, the whole idea of investing one-on-one, we're actually going to talk more about stockbroking portfolios, but the idea is, once you've started your savings journey, one, to check, are you on the right savings journey? And two, at what point should you start building a share portfolio? At what point do you add a share portfolio to your investment mix? And when is it appropriate for you? So we're going to talk about that a little bit, and then we're going to talk about the mechanics of creating a share portfolio. Optimal. I've got a couple of strategies on how to create effective share portfolios for beginners. You might not have time to watch it all the time. You might not have the understanding. So what are some general rules of thumb that you can use to protect yourself as well? Okay, let's go to the next slide. Okay, so who are we? Okay, so I'm gonna talk a little bit about who you should be. So I've looked at the delegate list, and I'm not sure if all of it is appropriate, but let's see. So the idea behind it is before we get to who are we? Why should you listen to us in the first place? So I'm representing Rand Swiss. We were rated the #1 stockbroker in South Africa in 2019. We were also rated the best advice broker. We won the People's Choice Award, and then last year we ranked as the best online trading platform, as well as the best tax-free savings account. So we've got some really interesting products. And why are we doing this event? So, my kind of day job, if you want to put it that way, I actually run a managed portfolio. So I'd much prefer you just gave me money and I managed it for you. So why am I going to sit here and give away all the secrets and tell you how to manage your own portfolio? It's basically because we want to win the awards again this year. And one of the categories that they rank us in is how much educational content do we give to our clients? How much support do we provide our stockbroking base? The clients that do everything themselves. If you have a look at our business units, as I said, so if you have a look at our business units, we kind of run a whole spectrum of different products for clients. So we run online trading products, which a lot of you guys, this really puts the tools in your hand to create your own share portfolios. You get to make all the buy and sell decisions. You never have to speak to everyone. We'll give you a beautiful mobile app. We'll give you an online trading system, and you can go and buy and sell MTN shares. You can go buy and sell Google shares. And it pretty much opens up the whole world to you. That was really the business that we started in almost 6 years ago now. Of course, you move to private broking. It's a very similar offering. The difference is, the account size is obviously, the account minimums are obviously a lot higher, but there you have a private broker working with you, someone that's going to kind of help you avoid all the pitfalls that we're going to discuss today. It's someone that, really holds your hand, helps structure your investment portfolio for you. If you kind of concerned about buying something like Coinbase, which recently listed overseas on the NASDAQ, you get to ask your private broker, what do you think of Coinbase? What research can you get? Can you get me some JP Morgan reports on it? What is the market doing about this? You've got an expert in your corner, and that's really what private broking is all about. So this event here is almost it kind of sandwiched between that. I want to give you the tools to be your own private broker, if you want to put it that way. Manage portfolios, like I said, that's kind of my day job. So we're managing client portfolios on a discretion basis. That's what I do the most, spend the most time on probably at Rand Swiss. As I said, I'd love you just to give me cash to manage, but at the same time, we want to rank really well on the awards. So we're obviously going to do these presentations for you as well. Structured products headed up by Viv. These are very alternative products. They're very complex, probably outside the scope of an investing 101 session that we're dealing with today. Now, offshore transfers, this is kind of a little subsidiary business that created because just so much demand, and we're going to talk about offshore versus local today a little bit as well, but so much demand for offshore investments from our client base essentially created a division all by itself, which is essentially helping clients move money from South Africa into international investment options. And that's that's a standalone business now on its own. We move to other, we have other brokers who move to other investment products that have nothing to do with us, and it's a totally independent business on its own, which is really nice because it was just kind of our demand that managed to seed it, and now it's got its own legs. So I'm really proud of what the offshore transfer business is doing. Now we've got kind of a formative wealth management wealth management business. It's more around estate planning and liquidity. It's kind of experts for our very, very big clients. We also work with a lot of private wealth managers that we endorse with those wealth managers. And we're going to talk a little bit about when you need a wealth manager and when you need a stockbroker and when you need an asset manager and the difference between all of these terms. But yeah, we have a small wealth management offering as well for our bigger clients. And then we've got obviously the tax-free savings accounts, where we won the award last year for the best tax-free savings account in the country. Very low cost option. We're going to talk a little bit about when you should have a tax-free savings account and what they're all about. So as I said, what are we going to talk about today? First of all, I want to start with what should you already have in place to be listening to this event, to be considering starting your own share portfolio. What should you have in place? Part of that discussion is, as I said, the big debate that kind of raged between our wealth managers and our stockbrokers last night around, is an RA the first vehicle that you invest in? Is a TFSA the first vehicle that you invest in? What is right? And I think the question that a lot of people are asking at the moment is, an RA still the kind of vehicle that people should be investing in? So we're going to talk a little bit about that as well. Then I'm going to go into kind of the basic tactical asset allocation. How do you structure a portfolio? What should you be doing? What kind of rules of thumb are there out there when you're building your own share portfolio? Just understanding those rules are going to, I think, help keep you on the tracks. It's like bowling, you're putting up the side rungs. Hopefully you're not going to get a gutter ball. So that's, I think, going to help you just keep in the right direction at least. Then we're going to talk about a couple of basic investment strategies around share portfolios. Simple, I've got 3 simple strategies that you can use just to keep your investing on track to try and avoid those really common mistakes that people make. And then I've kind of picked a company, so one of the new additions to our managed portfolios, and I'm going to take you through some very simple fundamental analysis. You don't need to be a chartered accountant. You don't need to be an investment professional. You don't have to have years and years of experience in markets to kind of have a look at these basic factors when selecting a company. And I think, I've worked with so many clients over the years, self-directed clients that work with us on an advisory basis. And I can tell you one of the biggest things is, you look at a company that's lost the client money and you start almost doing the autopsy afterwards and you look at what went wrong and you kind of go into some just very basic fundamental analysis and you kind of can't understand why the client was buying this in the first place. And had they known what was inside the company from the get-go, they never would have invested in the first place. So just a couple of simple fundamental rules that I'm going to take you through today as well. Okay, so what should you already have in place? And now this is kind of the very contentious debate that raged last night. So I've got some chats here. I just want to have a look at them quickly. Good day is recorded. Yes, yeah, we are recording the webinar. I don't know if this one will be available. So we're kind of picking and choosing which webinars to put up on the YouTube channel. The whole YouTube channel and the whole YouTube concept is quite formative for us. So we will try and put it up. Like I said, there is a recording, so we can share the recording directly afterwards as well. You'll just need to speak to Pascal, or you can send it to marketing@randswiss.com. They should be able to help you with the recording. What does small wealth management offer me? How do I qualify? So a wealth management, like I said, we're building up our wealth management offering at the moment. So basically, if you look at, we're going to talk a little bit about when you need a wealth manager. So I'm going to answer that as part of the presentation. Okay, what should you already have in place? Okay, so there's a couple of things that you need to have a look at when you're starting your investment journey. Before you can go and buy a share portfolio, there's definitely probably, I would say, 3 things that you should have considered. So the first thing that you must have considered is, have you made your retirement planning decision yet? What have you decided in terms of your long-term savings vehicles? And now I'm talking your RA, your pension, your provident fund kind of investments. Most of those investments, which sit in what is called the compulsory space, are pre-tax money. So, either you're employed and your employer is contributing a portion to the pension fund. You're part of an umbrella scheme, or there's some sort of employee benefits at your business, and you're already putting a part of your salary away. You might have also decided that you want to do a pre-tax investment by an RA privately. Now that RA also, that kind of forms part of your retirement planning decision. That you should really be starting as early as you can. And we're going to talk a little bit more about the retirement planning in a second. So that you should already, before you're thinking about a stock portfolio with after-tax money, you should have already explored vehicles that you can allocate pre-tax money to. Like I said, we're going to talk a little bit more about that in a bit. Do you have enough emergency funds in place? So whenever you're investing in a stock portfolio or share portfolio, you're obviously taking on a higher risk investment vehicles. We'll talk a bit about the concept of risk as well later on in the presentation. But what do you need if your car breaks down? If you have just unexpected expenses, your geyser bursts, all of these things. There's so many things that can happen in life. Do you have enough liquid assets that you don't need to go and draw down on a share portfolio that might be going through a period of volatility? Do you have enough in the way of these assets to see you through any emergency? Now, the kind of rule of thumb, we're going to talk a lot about rule of thumbs today as well. The kind of rule of thumb is you should have at least 3 to 6 months expenses in a liquid money market type vehicle that you can access at any time. Obviously, with everything changes all the time in investment as well, and that was kind of the rule of thumb. And I think people will probably be a little bit more conservative now, given the coronavirus and what's happened, and the idea that you can just shut down economies because of a pandemic. Suddenly, I think people might be a little bit more conservative with that, and you might potentially want to move your emergency fund out to having a year's worth of expenses, because as many people felt when you're losing jobs, there's a huge amount of business uncertainty. People are moving on to 50% salaries. There was a huge economic disruption now, and we all felt it in our lives. And suddenly you kind of look back at the period, and you look at your investment plan, and you look at how liquid your investments were. And I'm sure you've almost just stress tested this. So I'm sure if you hopefully back at work, if hopefully the economy starts picking up as we're seeing in the economic numbers, this is a time to definitely rebuild that emergency fund. And that emergency fund should be in lower risk, more liquid assets, which we're going to talk about kind of the risk spectrum later on as well. But definitely have an emergency fund in place. How much is right for you as an emergency fund is very, very difficult to say. And this is one of the things that you do need to speak to a wealth planner about. Different people, if you're 21 years old and you're just starting out in the world, and you live with your parents, and of course, you probably don't have the kind of responsibilities that you need to have a large emergency fund. If you have 2 kids and a huge bond, and you're just making ends meet, and your situation is going to be very different. So it's very difficult for me to talk about what the right size of an emergency fund is. I can say you definitely need to have one in place, but that you have to speak to a wealth planner about. And we're happy to kind of share details either with our independent wealth planners or with the wealth planners that work with Inner Swiss as well. So if you don't yet, or you're kind of uncertain about that, please do contact us after the event. Then you get your tax-free savings account. Now, the whole idea behind this presentation is what do you do after your tax-free savings account? So let's quickly run through. We do an event where we talk about what tax-free savings accounts are all about. But what is a tax-free savings account? It's a vehicle that is almost a gift from the government. You can contribute 36,000 Rand per year into a TFSA. You have a lifetime limit of 500,000 Rand that can be put into a tax-free savings account. You can go over the 36,000, but you definitely shouldn't, because if you contribute more than 36,000 per year, you'll be taxed at 40%. But this is essentially a post-tax savings vehicle, and it's an amazing savings vehicle in that you're going to not pay any tax on it. Essentially, when you come to sell your ETFs or your mutual funds or whatever you put inside it, you get to avoid all the capital gains impact. So it is the best way to structure a tax-free savings account is generally long-term. A lot of the banks will sell you on the idea you should have a tax-free savings account that you can save on the interest in a tax-free savings account. For us, that really doesn't make sense in terms of a planning vehicle, and it really doesn't make sense. But we've got an entire webinar around tax-free savings accounts. So if you're kind of unsure about how they work, I'd really suggest that you sign up to the webinar on tax-free savings accounts, and it'll kind of take you through the calculations and the best way to structure this wonderful tax-free savings vehicle. Now, what we're talking about today, obviously, is that after all of this stuff has been put in place already. Now, I've put in an obvious disclaimer. We've talked a little bit about it as well. This is actually from, MoneyWeb's got a huge amount of advisors and Q&A things on their site. This was pulled from one today. Please note these recommendations are based on limited information. I don't know who you are, so I have to take a very general approach to this. So you're welcome to ask questions as we go along, but really, this is something that you should be sitting down with someone to look at your personal situation, and you'll see what I'm talking about when I get to that. Okay, so I've got a question. The emergency funds, what is the best vehicle to use saving towards these funds? Just to earn a return on these funds. Okay, that's a great question. Now, again, different people will have different requirements in terms of the emergency fund. Is your emergency fund, designed because you have 3 kids? Or is your emergency fund literally just something, if your tire blows out in your car because you live with your parents? It's a very difficult question. And in structuring an emergency fund, you can do a lot of different things to try and boost up those returns. Typically, an emergency fund would just be put in a money market account. So we can, but as you kind of build, and depending on the types of emergencies that you're trying to plan for, you can get a little bit more clever with fixed deposits, with notice call accounts, money fund accounts, and etc. Obviously, at the moment, unfortunately, interest rates are very, very low, so it's difficult to find a nice high yielding money market fund. We have a very, very competitive suite of products to invest in for our clients. We generally put it into the Investec Money Market Fund. There, you have total liquidity on the fund, and it gives you a better interest rate than most savings accounts or kind of high interest accounts at the banks. As I said, they call accounts, and you get very, very attractive interest rates. So if you're looking at setting that up, again, you first need to chat to a wealth manager before setting up an emergency fund. It's kind of a little bit outside the scope, but just thought I'd put that out there as well. So I hope that answers your question. But again, I cannot stress enough, you should be talking to one of the wealth managers about this. Okay. So now I've said a lot that you should talk to our wealth managers. When should you actually talk to them, and when can you just use a stockbroker, and when should you be taking care of your investments yourself? So I've got 3 slides here. So the first one is most clients, when they're thinking about investment, only think about performance. Now, that is a terrible, terrible mistake. That's kind of, I'd say, one of the big pitfalls that we hear. Someone will say, oh, but I invested in Bitcoin and I made I've tripled my money, or I've quadrupled my money. This is a great investment. It's not necessarily a great investment if you haven't taken into account the risks. Just because you have performance doesn't mean that you've structured your investment portfolio correctly. So performance is it's probably less than half the story. Because the other half of the story is the risk that you're taking to create the performance. Anyone can go to a casino and chuck a whole lot of money on red. And hey, if you win, you got great performance. This is not a viable long-term investment strategy to go and gamble away your savings. Eventually, you will lose. So whenever you're thinking about any investment, you need to think about the risk. Now, if you don't understand not only the risk, so the instrument risk, so the risk that there is in the underlying instrument that you're choosing to invest in, if you have no idea what Google does, how Google works, who's running Google, what the competitors of Google are, if you have no idea what's going on in there, you don't understand the risks around that company. But it's not just the company risk that you've got to think about. In this term, that's what I'm calling instrument. You've also got to understand your personal risk profile. So are you 54 years old and you're about to retire and you've got this complex requirements to unwind? You might be converting RAs to living annuities. There's all the stuff that's going on. And at the same time, you have very few years left to earn. Because of that, you have to take a much, much lower risk than someone that is 21 years old. If you've just started saving, you've just got your first job and you're starting to really make money, you have very few responsibilities, but you're starting to get a big paycheck, that's a very, very different risk profile. Now, what happens is you've got to boost up. You've also got a longer time horizon, so you can withstand more volatility in your portfolio. And you need to make your money work for longer as well. So when it comes to understanding risk, you need to understand your own personal risk. If you don't understand where you sit on the risk spectrum, if you don't understand you're a high risk client or a low risk client, or what kind of risk you can adopt as a person, you should probably speak to a wealth manager. They'll go through a full risk profile with you. They'll do it's called a needs analysis as well. They'll kind of ask you all these questions, and they'll actually create a score for you around your risk so that they can then start your tactical asset allocation. If you don't understand the instruments you're investing in, you shouldn't be making those kind of calls. So for me, if you don't understand your personal risk and you don't understand the investment instruments that you're investing in, then you shouldn't be doing this yourself. That's like doing heart surgery on yourself. Going, oh, but I watched a YouTube video and they told me I could do it. Now, this is very prevalent in financial media. Like I said, we're a stockbroker, we're an investment house. I'm trying to give you very unbiased opinion here. But, when you listen to radio, when you listen to these kind of like investment schools, their whole idea is they're trying to sell you the idea that you can do this yourself. In many cases, they're right, but in many cases, they're overselling the fact that you can do this yourself. Some of these investment decisions on the investment processes that are put in place are very complex. It is. It's literally like doing heart surgery on yourself. You shouldn't be doing it. But yeah, that's kind of when you need to speak to advisor. So when can you kind of move away from having a formal financial advisor? When do you need to speak to a financial advisor? And when do you need to speak to kind of an asset manager or a discretionary portfolio manager? Now, for me, the difference is when you understand your personal risk. And it's one of the reasons that often when someone is just starting out in investments and they're quite young, like I said, you kind of fit almost in this model where, you're starting to get salary, you don't have a lot of responsibilities, your kind of basics are sorted out already. You don't have a complex wealth arrangement because you're young and you're starting, you're kind of a young saver and you're going through this. You might understand your risk. You understand that you should be taking higher risk. You should understand that you should have a high equity allocation in your portfolio, but you don't understand the underlying companies. You don't have enough time. You've got a full-time job. You're working at something else. You are the professional at something else, and you need someone to help you buy and sell the correct instruments underneath. Is MTN better than Vodacom? Should you be holding Netflix or should you be holding Disney in your portfolio? You might not be sure of the underlying instruments, but you understand what risk profile you are. If you do that, in my opinion, you can go directly to asset managers there. You can either buy mutual funds that sit in the right risk class for you, or you can have a discretionary portfolio manager where you chat to them and say, listen, I'm a high risk client. I want to go and buy shares. Let's go and buy a portfolio of shares, but I want you to help me structure the underlying shares. This is kind of where our managed portfolios fit in. If you understand that you're high risk and you want offshore, I run a wonderful offshore portfolio for you that has outperformed the MSCI World 4 out of 4 years. We pick some really good companies for you, and you give up the responsibility, but you want equity. I'm not buying bonds. I'm not kind of doing an asset allocation for you. I'm not doing a risk profiling for you. I'm literally just trying to get you the best performance on a risk-adjusted basis. So that's kind of when you should ask for a discretionary portfolio, is when you don't understand the instruments, but you do understand your personal risk. And then finally, when should you just go this alone? When can you be an online trading client where you really don't need a wealth manager or a stockbroker? And it's when you understand the risk, but you also understand the instruments that you do. Maybe you're a young CA, you've kind of gone through this, you understand how companies work, or maybe this is just a portion of your capital where you say, oh, I'm willing to have a go. I understand how, I work in construction and I understand how construction businesses work. And I really think that I can go and buy some Murray & Roberts. I'd really like to own some Murray & Roberts shares. Nothing wrong with that. You understand the instrument you're investing in, and you understand your own risk profile. In that case, I think you are probably well equipped to use research. Obviously, you need to look around and you need as much support as you can get around this. But there, you're a stockbroking client. You can just go directly into it and handle your own portfolio. But you should understand both of those things. So now let's go take a step back again and go, does an RA still make sense? So now with the RA, this is one of the kind of lead questions in there. So when should you have an RA and when shouldn't you have an RA? So if you've decided that you don't have a wealth manager, but you want to manage your own investment portfolio, and you've got your tax-free savings account, but you're wondering about what vehicle happens next. Now, as I said, the debate kind of raged, and a lot of people might already have RAs and then have topped up their tax-free savings account. That is possible, but a lot of people will do a tax-free savings account and then and don't yet have an RA. So, just wanted to kind of touch on what is the benefit of the RA and why are people even debating whether this is a good idea or not, given the huge tax advantages that you get. So what is an RA? An RA is a retirement annuity. Contributions to it are deducted from your taxable income. So you essentially contribute to the savings vehicle before you've paid tax, which is wonderful because you get an enormous saving. So let's say you made R1 million in taxable income, but you only contributed, you made R1 million in taxable income and you contributed 100,000 to an RA. Your taxable income is then reduced to 900,000. So you are only going to get taxed on 900,000 rands worth of income that year. And you essentially immediately make a 41,000 rand tax savings because you haven't paid 41,000 rands worth of tax when you essentially on that investment. So your after tax performance is boosted. Now there's kind of a little bit of a caveat to this as well, because remember that when you're investing in a retirement annuity, all that money is going to be pre-tax. So yes, you get all the growth on the money over time, and yes, it sits you haven't yet paid tax on it. You will still pay tax on it when you withdraw your money at the end of your investment life cycle. The difference is that when you get older, the tax rules change. So I've got the basic tax bands up for 2022 on the right-hand side of the slide. That changes when you get over certain ages. So the older you get, the lower the tax rate is, the bigger your exemptions get. So it is cheaper to withdraw the money later on. You also make a huge amount of savings because of any switching within it also comes out tax-free. So there is, from a flexibility point of view, like you also save tax in that way as well. So there is a large tax saving in this, and that does boost up your income. What are the caveats? Okay, there are rules around this, just like tax-free savings accounts, which are limited to 36,000. Obviously, the government doesn't want to give away its entire tax base through just to encourage you to save money. So there are limits on what you can do. Now, the limit is you can only invest 27.5% of your income, or up to 3,000, at least 350,000, whichever is lower. So and this applies to all retirement savings products. You aren't going to be allowed to invest more than that. So there is a point where you can max out the RA. So if you were looking purely at the mathematically most advantageous way of creating a long-term savings plan, an RA should definitely be part of it if you're just looking at the pure maths. Because what happens, you're obviously getting all that big tax break, which you're only going to draw much later on in life. Now, why do people kind of worry about this now? So the other caveat to having an RA is that it needs to follow something called Regulation 28. And this is where people have started to get very concerned that even though you're getting this big tax saving, there could be an implication for other implications that hinder your performance or make it not attractive for a younger person to hold an RA. Now, Yaku does a wonderful presentation on this called the Great RA Debate as well. So I'm going to just kind of gloss over the key points. But if you're interested in kind of really finding out, is an RA right or wrong, I would highly recommend that you go and watch that presentation as well. I think there is a recording on the website, but he also gives them at regular intervals. So just register for the next one if you haven't. Okay, so what is Regulation 28 and why has it got everyone worried? So Regulation 28 is essentially, like, the purpose of Regulation 28 is actually to protect investors from undiversified investments. It's actually saying that's the official reason for Regulation 28, is so that you don't put all your savings in one type of asset. You can't go and buy one big stock and lose all your money. It's designed to protect investors. Now, what's happened, unfortunately, is that because of that, okay, so these are the basic rules. So you can only have 75% in equity, 25% in listed property. Only 30% of it can be in offshore assets. Alternatives like alternative investment classes like hedge funds can only have 10%. Now, because of these limits, the big criticism has been that the JSE, so the underlying South African index, hasn't performed over the last 5 years. And because it hasn't performed, people have really criticized the 30% offshore asset limitation. They're saying that if you don't take the tax benefit that's on offer to you, and you instead go and invest directly offshore, so as in you pay your tax, you get after-tax money, not pre-tax money, and you invest offshore, the additional performance from the offshore markets and in that stage a much weaker rand would have more than compensated you for the tax benefit. Now, that in itself, this is where Viv and I often talk about, in investment, there's two things. There's the art and there's the science. Now, the science of investment is, and I'll talk a little bit more about art and science in a second, but the science of investment is, if you're going to a wealth manager and he's charging you 3% for advice, or you're in a portfolio that gives you exposure to the S&P 500, but you're paying 2% for that portfolio, and we kind of have a look at your portfolio and we give you the exact same thing at 1%. That's science. You're going to save 1% over time. That's going to compound. You have a better investment vehicle. There are many substandard investment vehicles out there, and the science is knowing which ones are substandard and which ones are not. So in that case, that's the science. Now, the art of investment is kind of trying to predict the future based on very uncertain set of parameters, and that's more of an art. No one could predict coronavirus. Yeah, so could you predict it? You wouldn't have predicted coronavirus, but I think Bill Gates was going on about how, the next pandemic, there's going to be a pandemic at some point, but there's uncertainty whenever it comes to investing. So saying hands down that investing overseas is going to generate a better return than South Africa is very dangerous, because you don't know how technology changes. You don't know how the world changes. Predicting the future is always uncertain. You might have a strong inkling, but that is more the art side of it. So, when you when you're making the decision whether you want to invest in an RA or not, you're making a subjective judgment as well. This is not just a mathematical thing that you're doing at the stage. Now, what influences that kind of decision? So for me, there's only two reasons why you wouldn't invest in an RA. The first is that you don't see performance from the South African market, and that's the Reg 28 concern that we're talking about. Because you're limited to the South African market, if you are very pessimistic about the future of South Africa, you probably don't want to be investing in an RA because you believe that you're going to get that additional performance that is going to compensate for the tax benefit that you're getting from doing it in there. Now, the second reason that you might opt not to is your life plan requires much higher liquidity than usual. Now, as I said again, I'll reiterate this, you should be talking about your personal circumstances with a financial planner or with a wealth manager. Now, when you require much higher liquidity than usual, remember your Regulation 28 funds, there's huge penalties to withdraw, to get out, and there's much less, how can I put it, there's much less flexibility. Generally, you're going to have to wait for 55, and even then you're going to convert it to a living annuity, and you're only going to be able to have, a specific drawdown. The money is much, much more tied up. So here are some concerns when I kind of said, what are the reasons you wouldn't want an RA to the wealth guys? They immediately chucked out a whole lot of answers, from socio-political concerns to, changes to the Regulation 28 framework, to ESCOM, to complications with immigration planning. There's a whole lot of things that they threw out. But for me, all of them do slot into those two things. If you're very pessimistic, if you've got socio-political concerns about South Africa, if you believe South Africa is becoming very socialist and private listed businesses are not going to have their property rights protected, and they're never going to be able to make profits because they're basically going to be looted, and we don't have the right corporate governance standards in place, you probably don't want to invest in South Africa. But what does that mean? That means that you have a performance concern. Changes to the Regulation 28 framework. Now, there's all sorts of concerns about prescribed assets. There's all sorts of things that could limit. Now, once you've put your money in now, and this is whenever you're going for like a tax planning solution, well, you can kind of think of tax as it's a wall, right? And every now and again you find these loopholes and you go through the wall. But the problem is the wall is changing because the government can change the regulation at any time. A good example is that, how a lot of people were using South African trusts to obviously get it wasn't to evade tax, it was to avoid tax. Legal versus illegal. Now, when they go through the wall, so they go through the tax wall, and then the rules change, sometimes you find you can't get back on the other side. So if you're contributing into a Regulation 28 product like an RA, there is the risk that they might change the rules as to what that means. And you might not be able to get your money out and they just change the rules. That happens. That is part of tax planning. And you've got to kind of try and make the best decision you can with the information that you have available. Again, I'm going to lump that under performance. Like if things suddenly change, and it's the only reason that you should be concerned if it's a long-term savings vehicle is that you're not going to get the kind of performance. Will they use our pension money to fund state-owned entities like ESCOM? Is ESCOM going to limit the companies that are listed on the JSE to such an extent that we're not going to get performance? Again, for me, it's a performance concern. Complications with planned immigration. If you're planning to leave the country shortly, you probably shouldn't be contributing to an RA. That it just doesn't make sense. But again, why would that be the case? Your life plan requires much higher liquidity than usual. You need that liquidity because you're busy immigrating. You're going to move overseas. You have a different plan. Again, that's a very personal situation. The possibility of pension funds being used to support the NHI, and again, that kind of triggers a performance concern. Another one that I kind of thought of as well is, what happens if you're an entrepreneur and you're starting a business? You need huge liquidity to start a business. Now, as a financial advisor, would you recommend that someone doesn't start a business when they have all the tools available to them, but they need that extra liquidity and they didn't need it? They've now locked it up all in the RA, and it's going to prevent them from accessing the capital required to start their dream business. For me, that was one of the reasons I delayed RA, having an RA for a long time, because I wanted to start a business and I needed that liquidity. Again, it comes down to number two. Your life plan requires a higher liquidity than usual. So there's a lot of reasons why you might not want an RA. But again, if I can say anything, it's speak to a wealth planner about it, because your situation is very personal. Now, this is my scary statistics page from another presentation from 2015. So this is just something that I wanted to show you guys as well. I feel like I should put my head on the block. Do I think South Africa is going to be a safe place to invest long term? If you were, like, and I'm imagining the audience here as like kind of between 25 and 35, Would I say, hey, for the general person, should you go and get an RA when you have GDP growth that even before coronavirus was collapsing, unemployment at 27%, manufacturing that's in the toilet, that's PMI manufacturing below 50 means that our manufacturing sector is contracting. Would I want to invest in a country like this longer term? Because that's what you're essentially doing when you invest in RA. Another scary statistic gone. Throughput, high school throughput at least. So how many people are actually passing, or what is our education system producing? Is it going to produce a generation that can effectively create businesses that will multiply your wealth as an investor? Very scary. This is just the quality of maths and science education. South Africa is rated like 128 in the world. I mean, that's terrible. US is rated 10. I mean, our maths and science is low. That doesn't generate the idea that we're going to have a lot of investment. So all of that is saying to me, this is a scary place to invest longer term. I would probably say diversifying offshore is a good idea. But before we continue, this is what a performance chart that I put up the other day. And this is kind of the first, like we're finally getting halfway into the presentation to the first real investment lesson. Investing has everything to do with buying at the correct values. All of those scary statistics that you're seeing back here, and all of the horrible bad news and the pessimism around the South African investment landscape, a lot of that is already priced into our equity markets, already priced into our companies. There's the saying in financial markets that if it's in the press, it's in the price. It means that if we all know about it, it's already reflected in the prevailing price of the assets. Now, this chart here shows you that over the last year, now, yes, I'm going to get a huge amount of flack for this chart, and I have already on Twitter, because it's just one chart, and I picked the start date of it. Not really, because I mean, I am doing another presentation on Friday where we kind of chat. Every month I give you what's happened on global markets, and I give you a 1-year view and a 1-month view. And it just so happened that last month we were the best performing index. So the South African stock market was the best performing index over the last year by a long way. We were the best performing over 3 months. We're the best performing over 6 months as well. How can South Africa, who came into the pandemic a wounded animal, if you want to quote one of the PSG's executives. We had huge problems with our economy before we came into the pandemic. How on earth can we be the best performing market coming out of the pandemic? And yes, of course, it's base effects. One, it's the commodity prices have gone absolutely berserk, and we're a commodity-driven economy. Some of our commodity companies are just absolutely flying, which is making Reg 28 portfolios look amazing. But also, it's a valuation story. South African markets are a lot cheaper than the international markets. And because a lot of that pessimism is already reflected in the price, it isn't obvious. Anyone that says to you that it is obvious that you shouldn't invest in an RA or you shouldn't invest domestically, that's not fair. If something is very obvious in investment, it usually isn't, because it's just the nature of how investments work. Obvious investments get snapped up very, very quickly, and like I said, there's an efficiency to these things as well. So basically, there's another quote. I think it's a Warren Buffett quote as well. I've got quite a few Warren Buffett quotes later on. Stocks aren't cheap and popular at the same time. It's just not the case. So if you're looking for kind of value shares, looking at like an economy like South Africa, it might not be a bad idea. So the idea that you just shouldn't buy an RA because of performance, I think is a very dangerous one. As I said, we've got a whole presentation around the RA debate, and I would encourage you to go and watch it. So that's through the very dangerous territory of the wealth managers. And now I'm on to kind of structuring portfolios and kind of the stuff that I do, which is the fun stuff. Okay, so this should happen before you select the vehicle. Okay, so before you kind of select like what you're going to buy, how you're going to buy it, what kind of shares are you going to buy, the first question you really should ask yourself is what is your tactical asset allocation? How much should you be investing in equities? How much should you be investing in properties, bonds? Now, the big kind of asset classes, if you want to put it that way, is equities, so it's shares. Then the other one is bonds. So it's either the equity financing of businesses, or it's the debt financing of businesses and governments, because there's also obviously corporate and government. So those are the big asset classes. The next one is obviously cash, so holding money in money market accounts. That's not really, as I said, you should have an emergency cash, but most people, that cash should be fairly low. Cash is always going to be your worst performing asset class, and it generally is a parking spot. Property is interesting because you obviously get all the different types of property: residential, commercial, industrial, etc. And property and equities are often lumped together, but they kind of behave like bonds. So a lot of people strip out property themselves as well. So you can kind of plan how much of a property exposure you do want. Again, with the kind of, in my mind, the average view of this being between 25 and 35, the young saver. You guys might have just bought your first residential property. You might have decided that instead of buying equities or kind of going into stock markets and building a portfolio, you were going to do a buy to let property. Now, that comes with all sorts of problems on its own, but I do believe there should be some property exposure in someone's portfolio. What about buy to let? It's a difficult question. South Africa, if you look at the rules around property, around tenants and landlords, they're heavily skewed in the favor of tenants. It's very difficult to be a landlord in South Africa. Now, just because it's difficult doesn't mean it's not worth doing. Currently, rentals are absolutely in the toilet in South Africa, unfortunately. So buy-to-let property is a very difficult sell at the moment. You can get high yields elsewhere. But yeah, and it comes with all the hassle. So for us, it probably makes more sense to go into like a property ETF or into property stocks directly and gain your property exposure through your stock portfolio. You're going to save yourself a massive amount of nightmares. And then they've got commodities as the other asset class. Now, typically, like commodities are considered an alternative investment class. And so I'd probably prefer to replace commodities with alternative assets. So there you can have your hedge funds, your commodities, your gold, your baseball cards, your Bitcoins, whatever you want. And that alternative asset class, that's really to create some sort of diversification in your portfolio. And it's to kind of try and pick up assets that are non-correlated to general economic cycles. Bond markets, equity markets, money markets, all correlated to the general economic cycle. Those alternative assets like commodities and Bitcoin and gold and whatever you want to think, baseball cards, and they're often not correlated, and that gives your portfolio a little bit of stability, even when the markets are going through something like we had around this time last year. So now we've kind of talked about the basic asset class and what they do. Where do they sit on a risk spectrum? Now, remember that there are many types of investing, but every instrument obeys the risk return function. You can't have, you know what they say, when it's too good to be true in investment, it usually is. When someone comes to you and says, I've got this really high returning investment that's really, really safe. So they sit in kind of up here. I don't know if you can see my curve, but so it'll be up top left. You can see my mouse cursor. Let me annotate for you quickly. There we go. So if you can see my mouse cursor up on the left here, that space all the way above the curve there, that's a high return, low risk investment. You know what? There are unicorn investments that come along now and again, but generally they don't exist in markets. Why? Because if they exist, people, like through arbitrage, they disappear very, very quickly. They just become full almost instantly. So generally they don't exist. Every now and again they can, but 99% of the time when someone's coming to you with a low risk, high return investment, it's just rubbish. It's just a scam, and you're gonna lose your money in the end of the day anyway. Then you've got the other side of the spectrum, which is like anything below that curve. Now that's the high risk investment with a low return. Plenty of those. Like, while there's no investments above the curve, or very, very, very few, there's plenty of investments below the curve. There are many, many, many substandard investment products. And that's where you should be working with your stockbroker or your advisor to identify which are substandard products and which aren't substandard products. That really is an enormous value add that your financial advisor or your stockbroker will be giving you. Their goal is to try and get you onto that curve. Now, your wealth manager is going to tell you where on the curve you should be sitting, given your age, given your risk profile, given the responsibilities that you have. They might be saying, you need to be, quite highly exposed to corporate and government bonds because you're quite old, and you need to have a low risk profile, and you're going to have, some equity exposure, but you've got to have a large chunk in the money market because you have a child that is on medication and is going to require medication for a long time and is never going to be self-sufficient. There's all sorts of personal situations that could crop up where you might need a very high, very low risk portfolio, and for that you can't generate the higher return. But yeah, plenty of products below that curve, so just watch out for that. Now, generally, that is the way that the asset classes work. So money market, low risk, low return. You put your money in the bank account, low volatility, but you don't get as much from it. The bond and property market kind of sits, as I said, they're sometimes equivalent, but property, it depends on the property. A property sitting in central London, or central London these days, not what it used to be, but nice Santon apartment, close to all the businesses which are now shut. Things change in investment, as I said, but that property probably a very different investment profile. You'll get a very different yield on that compared to a very speculative property in a very dodgy neighborhood. So property can be both high risk and low risk within an asset class, the same as bonds. You get high risk bonds, you get junk bonds, like if you go and lend South Africa's government money. We are junk status, so we give you a high rate of return because we're a very unstable bet. Versus if you go and give the U.S. government, if you go and buy U.S. treasuries, which are U.S. government bonds, you're going to get obviously a very, very low return on your money because your money is very safe. When you're looking at the kind of bond products, you're thinking about the credit risk behind the product. And then as you move up the spectrum, we move into the equity market, which is basically large cap equity. So if you've got a giant company, if you've got something like AB InBev, they serve 1 in 3 beers across the world. They pay a huge dividend, and they just sit and operate. The chances of AB InBev, the chances of AB InBev going bankrupt are a lot smaller than a venture capital startup going bankrupt. It's also, obviously, their growth potential is also a lot more limited. When you already serve 1 in 3 beers worldwide, what can you do? Maybe you can start selling wine. Maybe you can serve 1 in 2, but you can't because there's all these antitrust rules around it. They don't want you to serve every beer in the world by the same thing. You're essentially as close to a monopoly as you're allowed to get from a regulatory point of view. You don't have the same growth as a small cap would have. So a small cap might only be working out of Joburg. They can expand into Cape Town and Durban. That you can get 300% return. They can double their business and double it again. You'll get a much higher return. But hey, they're really small. They don't have the balance sheet. They could be wiped out overnight. And that's kind of why they're higher risk, but they're higher return. And obviously, emerging markets, equities versus developed market. Emerging market is considered a higher risk product. Okay, so we've got a question. Okay, that's for emergency funds question. Cool. Okay, then what happens next? Okay, so so I've just given you like the basic returns. So like I said, like if you kind of like, again, I'm imagining the average view of this presentation to be 25 to 35. What should you be investing in? I would say a high equity allocation is crucial. Again, comes down to personal circumstances. That disclaimer always in place. But if you have a look at what happens, generally, because you have a longer time horizon, you can adopt more risk. Now, this is giving you kind of like, it's almost an 11-year view. And I've just kind of put in some basic products. So Vanguard is one of the big passive managers overseas. And you can see the difference. So the blue line at the top, that is the S&P 500 ETF. So that's a general equity-weighted index, 254% return over the period. You've done exceptionally well. And then you've got 2 different products there as well. So you've got a long-term corporate bond and you've got a short-term corporate bond. Now, a long-term corporate bond product like that will experience higher volatility but generate slightly higher return. If you're lending people money for a longer period of time, you obviously get a higher yield on that because there's a longer time for them to default. There's higher credit risk. If you're taking a very short-term bond ETF in this case, they have very short dated. They'll have like 3-6 month securities. So there's much higher liquidity inside the portfolios. And because you're only lending money to people for a very short amount of time, you don't kind of get the same higher interest rate that you do at the other end of the curve. So what happens there is your return is going to be more like a money market return. Now, essentially that's why the orange one, which is the short-term corporate bond ETF, gave you a low return. But you can see as well the volatility that's being expressed here as well. While over time you are getting a much, much higher return in equities, the volatility is much, much higher. As you kind of move down the risk spectrum, you get a much lower return over a long period of time, but the volatility is lower as well. So that is why when you're looking at your tactical asset allocation, you're looking at like constructing a portfolio around risk, depending on what you are trying to achieve, you might want to take some low risk, some high risk. Now, if you 25 to 35, which is presentations for, you should be in the equity market, because in the equity market, you can go through the coronavirus and the bounce back. You can go through 2008 global financial crisis and bounce back because you're not going to sell. You have no pressure to sell. These are long-term savings that you're putting your funds to work in. It's very different where if you are saving, let's say, for a college fund or you're saving for your kids' education, and you know you're going to have to pay school fees in 2 years. it would be wonderful for you to take equity market returns because you want to try and expose yourself as much as possible to equity markets. But at the same time, hey, you're going to need that money in 2 years. What happens if you're about to have a coronavirus collapse and then you need the money? Suddenly, you're going to be withdrawing your money at the worst time in the market, and you're going to suffer, a significant drawdown where you didn't need to. You would need more stable money to make sure that that need is serviced. So that's kind of like the basic just performance of the different asset classes and why you want equity. This is just another one. So this is rolling returns. Okay, this only goes to 2014. It's kind of an old slide from an older presentation. But as you can see as well, over a longer period of time, like the compounded annual return gets closer. Up until 2014, I think it might have changed over the last 5 years, because like I said, the local markets had a very bad 5 years, but there was no point over 5 years in which a client would have lost money. Like on average, no matter, even if you invested at the worst possible time, over time, you would make money. As the time horizon extends, the likelihood of you making money is more sure. So over longer periods of time, risk actually drops in equity markets as well. And this is just to give you, like, this is another way of looking at the same thing. So so this is, I think this is the S&P 500, but basically this is to show you no, it's all shares, sorry. This is to show you what happens, like how those blips. So even if you invested at the worst time, kind of in the, back in the dot-com crisis, you would have taken a 44% drawdown, but markets bounce back. And even if you had invested in the worst time, you still would have a decent point-to-point return over a longer period of time. The same is like those blips get smaller and smaller like over time. So the same as the coronavirus kind of sell down looks like horrendous when we were going through it. Okay, this was a very, very quick bounce back by historic standards, but the chances on markets would be a lot higher. Even if you had invested just before coronavirus and you had held on, you would already have all your money back and growing again. So that's the idea. The idea I'm just trying to put forward here is that equity markets are a longer-term vehicle, is what you need to understand. Okay, so let's quickly go through some basic strategies for beginners. Okay, so now let's talk about you are going to build your own stock portfolio. You're going to kind of stick some cash in an account and you're going to go and pick some shares. What shares do you pick? Okay, so the first thing you need to know, okay, so this is... this is just like some very, like I suppose, simple rules to help you. Okay, use common sense over time. Okay, so we've already kind of like looked at the importance of investing and just what time does this all go. Even if you make bad decisions on your investment portfolio, often time will sort that problem out for you. So I've given you a whole lot. These are kind of like wisdoms that you can kind of pick up from a whole lot of different quotes and all about using common sense. So first, I'm going to start with the third one, which is basically around time. Warren Buffett, the stock market is a device from transferring money from the impatient to the patient. Whenever you're investing, like one of the things that you need to be aware of is you whatever you buy, be prepared to hold on. Do your analysis, understand what you're owning, but be prepared for very irrational things to happen. You might have looked at a company and thought, this is going to be a great company, and the next day it drops 20%. You can't worry about that and panic and sell. You've got to keep invested. If you're unless something dramatic has changed and the reason that the fall is something that you didn't understand, but in general, over time, you should be patient with your investments. It should be a very boring process of investing, if you want to put it that way. Okay, use common sense as well. So know what you own and know why you own it as well. So a nice kind of common sense way of investing, if you're not sure and you're not an accountant and you don't understand business very well, is investing. If you invest in companies where you use their products, for example. So I'm trying to think, like, if you're a client of Discovery and you're willing to pay them for your insurance, you see value in their products, so then it probably is something that you could consider buying. If you fill up at Sasol and you're like, oh, I have to buy petrol, yeah, maybe Sasol something that you would consider buying. Now, why is that important? That's important to stop just the total rubbish. I'm thinking of a company like Nikolai overseas. It's basically a design concept. You've never bought anything from them. Everyone got very, very excited about it. The stock went up, the stock collapsed. It was meant to be the next Tesla. The point is, the company wasn't really manufacturing anything. And when you get very, very complex companies that you don't understand, there is always the risk that company is not, is just in. And I mean, we see it a lot with client portfolios. Like they read a news article about some spectacular battery miner, battery component miner in Sweden or whatever the case is. And they have no idea. They don't use the company's product. They know nothing about the company, but they read a report somewhere on the internet that said this thing is going to be a spectacular buy. They go in and buy it, and 9 times out of 10, the thing ends up at zero because it was always rubbish. That doesn't happen to companies where you're buying and selling. If you drink Coca-Cola every day and you want to buy Coca-Cola shares, the chances are Coca-Cola is not the kind of company that's just going to be smoke and mirrors and air. Our market is a little bit different from overseas markets. So we are a lot more, in spite of Steinhoff and Tongart and a lot of kind of accounting problems in companies, our market is a lot more heavily regulated than some of the more buyer beware markets out there. In the US markets, there can be some real rubbish in there, and it doesn't matter. I mean, how can I say, the SEC allows things that the local regulators probably wouldn't allow as well. So it's just kind of like using common sense about like what the company does. Is it a company that is a valid company? Is it a big blue chip company? You're probably going to be safer looking at something like that. If you are looking at something more speculative, make sure that you understand the company. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Stick to quality. If you're starting out in investing, stick to quality. Don't try and go and pick those, the next hot thing that you don't really understand, but you read some reports and it sounds like you're going to make 1,000,000%. Generally, you're probably not going to make 1,000,000%. It's probably just rubbish. Like I said, if it's in the press, it's in the price. So rather, I would say stick with those wonderful companies at fair price, even if you're paying up for like an Amazon or a Google, or sticking to blue chips generally does help beginner investors as well. If the only tool you have is a hammer, it's hard to eat spaghetti. So again, common sense, like one of the things with common sense as well, and just understanding is like when when you're investing, like you do need to have the right tools to understand what you're doing. And it comes down for me, that kind of common sense point comes down to like the heart surgery point again. If you don't know what you're doing, and you know that you only have a hammer and you're trying to do something that is well outside your skill set, don't try and do it. You probably will end up losing money. And then rule 5, never lose money. Number 5, rule 1, never lose money. Rule 2, don't forget rule 1, Warren Buffett. Try and protect your capital. Like, it's great to go into very speculative investments. Maybe go and buy some Dogecoin. It'd be wonderful. If you're only chucking $5,000 in, maybe you'll make a fortune. Maybe buy a lottery ticket, sure. But that's all speculative. You need to separate your speculative activities from your investment activities. Investing is a serious thing that you're doing over a long period of time and should be very, very boring. So that's kind of the common sense strategy, if you want to put it that way. Some just general rules of common sense. Okay, the second kind of strategy I'd say is, like, as a novice investor, if you don't know what you're doing, diversify. Now, diversification is not a catch-all. Just diversify and you'll be fine. The saying goes, like, certainly from an entrepreneurial point of view, concentrate to create, diversify to protect. And this is kind of, I've given you 2 more. Like I said, I've got a lot of Warren Buffett quotes today. So I've given you 2 more Warren Buffett quotes. And the first one is, so I just need to move my face around. Why diversification is only required when investors do not understand what they do, which is true. And generally, as a novice investor, there's a good chance you're not going to understand what you're doing. So having a wide diversification will protect you massively by stripping out. You can, if you happen to buy a Steinhoff, and okay, that was accounting for it. It was very difficult for anyone to do. Professional investors got done by it just as easily as novice investors. But if you have only 1% of your portfolio or 3% of your portfolio in there, you're not going to face a catastrophic event when something goes wrong with one of your positions. And on average, if you're picking good positions, you'll be fine. And then Warren Buffett, in the same breath, different times in his life, but said, don't put all your eggs in one basket. At the same time, he was a fan of diversification as well. Warren Buffett's, it was a couple of letters to shareholders ago, he said, they asked him what would he, if Berkshire Hathaway, which is his company, wasn't around, what would he recommend he put his wife invest in should he pass away? And he said he would say S&P 500. Just go and buy a general low-cost passive tracker. And his view is it's well diversified. You don't need to know, you're basically just taking a bet on the US economy. You don't need to understand the specifics of concentration. You're not going to outperform, but you're not going to underperform either. And then, yeah, I've got kind of in the diversification, I've got a couple of different things. So choose different. So when you diversify, you want to choose different assets. And by saying that, so if you're building a stock portfolio, if you think you diversified because you bought Implats, Amplats, and Royal Buffer King Platinum, guess what? You're not diversified at all. You're hugely concentrated to the platinum price. So when you are diversifying, you need to try and diversify by splitting, by trying to find non-correlated assets. A good way of doing this is take the overall sectors in the market and try and pick one or two stocks from each sector. Do you have a bank? Do you have an insurer? Do you have a retailer? Do you have a mining company? And as you build up your portfolio, try and pick companies from different sectors. Different sectors have massively different inputs that drive their prices. So when something goes wrong in commodity prices, your whole portfolio isn't exposed to commodity prices. So just choosing non-correlated assets, an easy way to do that is just pick one stock from each sector. Keep on adding. So you might have heard the term Rand cost averaging, or dollar cost averaging, depending on what currency you're doing it in. This is diversification, but it's diversification through time. So essentially by constantly, and the way you do this is you keep adding to your portfolio over time. You can deposit a little bit of money into a stockbroking account, buy yourself a platinum miner. Then you get a little bit more cash, you put a little bit more in, and then you go and buy yourself your bank. And you slowly build up your portfolio over time. Even when you've got your kind of full strategy, you should just keep adding to the portfolio, because at times you'll be adding when we're in the dip from coronavirus, and a year later you're going to be up 82% in dollars. And at times you're going to be adding just before the coronavirus, where you're going to have to ride through the dip. But because you're kind of doing it at different times, you're not going to like invest in a very expensive part of the cycle, everything at a very expensive part of the cycle. At the same time, you are also diversifying to protect, not concentrating to create. The same as you will never be deploying everything down at the bottom of a sell-off, which is obviously going to generate a much higher performance for you, but it doesn't require you to make that call. And it's far more stable over time just to do that. Diversifying, yes, it's going to bring, if you're good, it's going to bring down your performance slightly. But if you don't know what you're doing and you're bad, it's going to save you an enormous amount of pain. So my idea would be diversify is something that you should do. I'd also say you don't need to over diversify as well. So we've had guys transfer us portfolios where they had like 300 different companies in the portfolio. It's not really required. So the kind of what I call the heuristic sweet spot, so it's a rule of thumb, is 25 to 30 stocks in a portfolio is considered a good level of diversification for the average portfolio, given the cost of execution. Now, if you obviously have a much bigger portfolio, if you're talking about 20, 30 billion Rand in your portfolio, you can get very, very wide because the cost of execution is not going to be high. If you're only putting 10 grand in an account, guess what? Like, you're not going to be able to buy 30 stocks in an account. You should probably be buying 2 or 3, or you should be looking at a passive tracker or an ETF instead to keep those costs as low as possible. Believe it or not, I don't want to earn lots of brokerage off you. I want you to be happy as a client. I want you to make money, because if you're happy, you go and tell other people, and then we get more clients. So I'd much rather you a happy client than an overtraded client. So I would say definitely, don't over diversify. Okay, so I just need to move this. Yeah, and then I'd say, okay, constantly reevaluate your portfolio as well. So the whole idea is, Warren Buffett quote saying that, his time horizon, his ideal time horizon is infinite. It's like the idea is that you never sell. When you buy a company, you should buy a company of such high quality and such good culture and such a great management team that no matter what happens in the world, they will always be able to adapt and change the business in a way that will leave you profitable. That is the ideal company to buy. And there are plenty of them that have incredibly long track records. So South African market, not as much, but overseas, definitely. I mean, you've got companies with 100-year track records that have proven that they can adapt to many, many different situations, that have amazing corporate cultures. The fact is, though, that buy and hold doesn't necessarily work. And the way that, you do need to change your portfolio at times. There is times where you need to reevaluate and you need to sell underperforming positions. You need to look at, I'm going to go through quickly a little bit of fundamental analysis for you as well. But, it is something called survivor bias. So when you look at markets and you go, if I had bought Naspers 25 years ago, I would have had this, and if I just held on to it, it would have been this. And you would have had a huge, huge thing. that's because Naspers did that. Naspers is still around. If you go, oh, if I just bought Apple years ago, just because Apple is now, like it's over $2 trillion company, doesn't mean that every company you go to buy on the stock market is going to do that. The stock market is littered with corpses. I don't have them here, but it used to be in our old offices. I have a whole wall of these share certificates. It's like really cool. They're all like share certificates for mining companies from like the 20s and 30s. We kind of had them all framed. Now, the idea is none of those share certificates are worth anything because the client, like people, they used to be worth something and they eventually, the mines ran dry, the companies collapsed. Shares aren't necessarily a long-term vehicle. Investing in shares and stock market is going to give you an outsized return, but you've got to be cognizant of what you buy and what you're buying as well. Buy and hold won't work. You need to constantly reevaluate your portfolio and make sure that you're still using that common sense and investing in things that are quality, that are good, that are going to generate you money. And then 5, I kind of touched on that already, is like don't overtrade as well. So yes, reevaluate. Yes, sell your underperformers. Yes, you've got to manage your portfolio as well. If you're managing your portfolio, you have to manage your portfolio. But at the same time, don't overtrade. Be cognizant of the cost of your trading. Be cognizant that if you're not going to hold a position for at least 3 years, there is a chance that you're not going to pay the much lower capital gains tax. You might be deemed as trading that portfolio, and it might generate income tax for you. If you're not doing that in a sensible vehicle like a company or something where you can claim expenses against it, that might not be the right way for you to be trading the portfolio. So just be cognizant of the cost and the tax. Again, with people that can help you if you're interested in that, get your structuring done correctly, and you'll do a lot better. I'll put it that way. So I'm running over time a little bit. Okay. So the third strategy, so this is the last strategy. Okay, top down versus bottom up. Now, this is what I believe in as a portfolio manager. So whenever you're looking at analysis, so how do you know when a company, I keep on talking about quality companies and buy things that are reasonable value. How do you know when something is a good company or something is a bad company? How do you know if you should add it or you shouldn't? So there's years of CFA work that you can go and do. There are thousands of theories. There are so many different strategies of telling one company from another. But I've just picked 2 of the broad ones, which I kind of like because it helps me illustrate the point of you can probably never have too many analytic tools when thinking about a company. So first of all, top-down analysis is very much it's macro-driven. So it's analysis. It's generally you look at the bigger picture. You look at the components that are driving it. You look at the sector the business is in. You look at like what the product is, what the product could potentially do to markets, and how markets are changing for that product. And you don't worry so much about what the company is actually doing. So let me give you an example of Coinbase, for example. So Coinbase, we've got, it's kind of a company we're going to talk about on Friday. So the one that's just listed on the NASDAQ. Coinbase is essentially a crypto exchange. There's like 45 crypto assets that trade on it. Now, a macro top-down view of that is before you can make a buy and sell decision on Coinbase, you don't need to understand what Coinbase's systems are. You don't need to understand who their clients are. You don't have to understand what their revenue looks like. You don't have to understand how much money the exchange is earning. What you need to do is make a macro call on crypto. You need to decide through your analysis whether crypto is something that's here to stay or whether it's something that's not here to stay. That's the big risk. So you're looking at this from a macro point of view. Another way of looking at it is looking at something like driverless vehicles or social media, for example. Social media, you can go and look at Twitter and Facebook and Google, and you can kind of try and understand the businesses from the business point of view, but that's only part of the story. The other part of the story is what are regulations going to do in Europe? What are these big macro forces that people are starting to look at their phone and already Microsoft saying, oh, you've only got an hour and a half screen time, is that too much, too little? And people are starting to almost push back against the constant demands that social media puts on them. Now, how is that going to affect the businesses? So before you look at the underlying business, you're looking at the environment the business is operating in. That's top-down analysis. Any company that you buy, one, understand what their products are, understand who they are, but you need to make a call on, is this something that's going into the future or not? Autonomous, we love the idea of medical devices, autonomous driving, AI, all of these things. That's why we own chip makers and all sorts of. When I say chip makers, not like slap chips. I'm talking silicon chips. But we own chip makers because we like that story and we like that top-down theme. That's the one angle of looking at it. But remember, whenever you're looking at a company, all of the different analytic techniques you use, they're just lenses that you're looking at the company through. So and incredibly important, and these are probably the two most important lenses that you should look at a company through. The other one is your bottom-up analysis. So bottom-up focus on specific characteristics. It's the micro attributes of the company. Here you're going into the company and you're looking at who's running the company, what are its earnings profile, what is its earnings done over time, how much are you paying, is the company going to need to do a rights issue, have they got a dividend buyback, at least have they got a share buyback program in place, what is their dividend policy, how are they remunerating their executives, what are their sales figures looking like, what products are they bringing us through. You want to know everything about that company and as much as detail as you can understand it in. And by understanding that, you now get a picture of, is that company, you might think, okay, social media is great. It's going to continue and it's going to keep flying. But now you can kind of make an informed decision. Do you want to buy Twitter or do you want to buy Facebook? Or which one do you want to buy? Because you understand the nuts and bolts of how that company is put together, not just the general sector. So that's kind of another strategy that I would say it's an analytic technique that if you're building a portfolio, these are things that you should be considering when you're looking to select stocks. Again, if you're not comfortable doing this, get a portfolio manager to do it for you. But yeah, those are my three things. And then okay, I'm going to wrap up now because I'm 10 minutes over. But simple fundamental analysis for your portfolio. So this, again, it comes down to have the right tools to do the job that you want to do. And so I've just given you, like I said, this is one of our newer picks that we've done. So I'm just going to take you quickly through the kind of things that you can look at in terms of a bit of portfolio analysis and a bit of bottom up. So, so I just want to get here as well. So, okay, so the top left, okay, so just get I think you guys can still see my mouse. Top left, okay, so this company is called Equinix. It's essentially data centers. So it creates data centers and it's structured as a property REIT. So it's a property company that specializes in data centers, because I don't like just buying property. Like in our local portfolio, we own storage. We don't own, we don't own just like a shopping center retailer, like something that just has shopping centers. We want the company to do something to add some value to that property to allow it to generate excess margins. What this property company does is it runs data centers. So it's one of the largest data center providers in the world. And it gives it's got clients like AWS, which is Amazon's cloud. It's got Google, Microsoft, all of these guys. They basically put their servers and their boxes in the specialist property REITs counters. Now, what happens here is obviously I've just looked at it. So this is basically by quarter their earnings per share. Now, there's probably an over-focus on earnings, in my opinion, in the way that people talk about shares, and under-focus on revenue. So you can see earnings a little bit choppy here and there, but remember that, like you look at a company like Amazon, one of the most valuable companies in the world, for years and years and years, they never showed any profit whatsoever. A lot of the value that is trapped inside stocks and bonds is not demonstrated by earnings, because the companies just they make so much in revenue, which is the top line of the income statement, and they spend all of that on R&D and development and growing and becoming a bigger and bigger business. And they don't allow profit to drop through to the bottom line because they don't want to pay tax. So for me, it's a better indication to probably look at the revenue line, like the revenue growth in the company, if you're looking at a growth company. Instead of looking at the price to earnings ratio, look at the price to sales ratio instead, because that's going to give you I think a truer demand of what the company's profits are. Of course, you want your company to be profitable. You want it to give you dividends and do share buybacks. But it's just the way that the world operates at the moment that it's not as important as it used to be. It's not that kind of like ethos doesn't flow through companies like it used to. So I'd say kind of be cognizant of the revenue growth and then have the right tools to kind of go there. So we've got forecast means of where the market thinks the companies are going to grow. So Equinix, they think they looking at it for the next 3 years out, they should be growing into mid to upper single digits in terms of revenue growth. And that's revenue growth in dollar terms. So they're growing revenue at about the same speed as kind of the S&P 500 average return, but at the same time, their EPS is getting really, really exciting as well. So they've got very, very high EPS growth, but it's because the company is becoming slightly more mature. It's also got, they've got long-term contracts, which kind of adds like an annuity dynamic to their revenue as well. What else? Nice, clear, easy thing to do is where does the company operate? What geographies is it in? So this one, I can go and pull like, oh look, 45% of this is coming from the US, 33% from Europe and the Middle East. Asia Pacific accounts for 21%. It gives me an idea of what this company, how diversified is this company geographically? Is the company a pure South African play? Do you understand that you're 100% invested in South Africa, or have you got a more diversified global approach to the company? As I said, each company is not necessarily bad or good, depending on what the underlying company is. I mean, AB InBev, wonderful, diversified brewer all across the world, but difficult to grow when you're that size. So there's the kind of size concern as well. But also, when a company gets that size, it's probably got the right structures and management in place that it'll be a little bit safer. And so I'd say, look at those are just some things that you need to consider when you're picking companies. And that, so I've got a couple of questions, but that's it. That's my presentation. Thank you very much for listening.